All right, this is some video notes for topic 4.7, which is one of the final topics for this unit on monetary policy. And we're going to introduce a new graph in this final topic, and that graph is going to be the loanable funds market. And in that graph in the market, we're going to talk about what influences the graph, how to graph it, and some of the variables associated with the graph. What I recommend when you take notes is when you get to a new slide in the video, just pause the video, write down the notes, and then play it when you're done to listen to the notes I'm going to offer. Here we go. So the supply and demand, the law of supply and demand influences the loanable funds market. There are four groups that make up the demand and supply of loanable funds. Those are the government, because when the government needs to spend money on, say, infrastructure projects or to fund a military operation overseas, usually it does not have that money sitting in its vault, so it's going to have to borrow money. So the government could demand more loans. That's what the loanable funds market is. Foreigners, so that would be an example of a Japanese company that's looking to invest in the United States and needs a loan to start this investment in the United States. So they would borrow money from a U.S. bank. A business here, a domestic business, a domestic firm would be looking to, say, open a new factory or a new office building. Chances are they're not sitting on that pile of money as the upfront payments. What they're going to do is they're going to demand a loan or need a loan from a local bank. And then finally, consumers themselves. Think about when you buy a car, buy a home, just make that big purchase. Most of the time, consumers aren't paying upfront with that money. They're putting that money on credit, on a mortgage, and that's a loan. And so when consumers are spending more or borrowing more, their demand for loans increases. You might be wondering, what influences the supply of loans? Well, these four factors influence the supply of loans, but banks and interest rates also influence the supply of loans, and I'll get to more on that in the next couple of slides. This is the graph for the loanable funds market. You'll notice that it's the exact same as a supply and demand graph. So this one's a little easier compared to your money market graph, where in your money market graph you have to have a vertical money supply curve. But in this one, if you get a question where it would ask you to create a graph of the loanable funds market, just draw a supply and demand graph. The reason why the demand for loanable funds, which is this green line here, is downward sloping is because if you look at the interest rate on the y-axis, think about it. If you were a consumer, you're much more willing to buy a home, buy a car on credit, on a mortgage, when interest rates are lower, which shows that when interest rates are lower, people demand more loanable funds. And if interest rates are high, people are going to demand less loanable funds. Think of the same relationship between price and quantity. When price is high, people buy less of it. When price is low, people buy more of it. Same thing holds true with interest rates here. That's why the supply of loanable funds curve is a positive correlation between the quantity and the interest rate. Banks are much more willing to supply loans when the interest rates are higher because as interest rates are higher, they're going to make more of a profit off of each individual loan that they hand out. They're going to get more of a return on their loan, their investment. These are some of the major determinants of the loanable funds market. I left some questions here for the first two bullet points. So with business confidence and expectations, what that means is, say you're operating a business that is going through a very good economic time. Say there's a lot of optimism. The economy is creating a good amount of jobs. There's solid wage growth. You're confident that if you open a new storefront or office building, you're going to have the demand there to meet your supply. So because you're more optimistic, you're much more willing to borrow from a bank to get a loan. And so because of that, the demand for loanable funds is going to shift right. It would be a rightward shift in the demand for loanable funds because you're more optimistic and willing to borrow money. The same thing holds true for the second bullet point about consumer confidence. People tend to buy more homes, borrow more money, put things on credit when times are good, when they have a good paying job, when they're confident they can keep that job, that the economy is going well. So the demand for loanable funds, again, when times are good, when there's an expansion, is going to shift to the right. You would just flip these in the opposite situation. So with a recession or fears of a recession, there's a lot of pessimism in the economy. You would have a leftward shift in the demand for loanable funds. When the Fed buys bonds, this increases the money supply. When the Fed sells bonds, this decreases the money supply. So when the money supply increases, it's going to have a negative effect on interest rates. Interest rates are going to fall. And so because of that, the supply of loanable funds could decrease slightly as interest rates get lower. When the Fed sells bonds, the money supply decreases, which over time drives up the interest rate. So banks are more willing to supply loans at a higher interest rate when interest rates are higher. Here's some other examples of shifts in loanable funds market. When the government increases spending, this is going to drive up their demand for loanable funds. So the demand for loanable funds is going to shift to the right. When the government cuts spending, they're cutting back on the amount of loans that they need. So the demand for loanable funds is going to shift to the left. The second bullet point here about income levels, this goes back to the previous slide. And optimism, when people are more optimistic, when there's increased levels of wealth, the demand for loanable funds is going to shift to the right. And then the last one has to do with the supply of loanable funds. When taxes increase on, say, an account that you gain interest on. So that means that, say you open up a certificate of deposit, it pays you a certain interest rate. The amount of interest that you earn, you have to pay a tax to the government. If the government were to increase taxes on the interest that you earn, there's less incentive for you to borrow money or to put money into a bank for a CD. So therefore, banks aren't going to offer as many loans when these taxes are higher because they know people aren't going to make as much. So therefore, the supply of loanable funds shifts to the left because there's less incentive, A, for people to invest their money in interest-bearing accounts, and B, banks are aware of this. They're aware of there's less incentive for them to make money and for consumers to make money, so they're going to supply less loans when taxes are higher. The last slide here has to do with the bond market. One of the rules about the bond market you have to understand is that when there's a negative correlation between bond prices and interest rates, meaning that when interest rates rise, bond prices fall. And one way to help explain this is if you look at the loanable funds market on the left here, and let's say this is supply and demand for bonds on the right. Let's say that people want to borrow more. They need more money to borrow from banks. So that means there's going to be a rightward shift in the demand for loanable funds. So as the demand for loanable funds increases, it drives up interest rates. And when interest rates rise, that means banks are willing to supply more loans because they're willing to supply these loans to make more of a profit off the higher interest rate. So that means the supply of bonds is going to shift to the right. And as the supply of bonds shift to the right, that means the price of the bonds falls. I don't believe that this is a video you could watch on your own. I think I assigned it as homework over the weekend that you can watch to help explain the idea behind the loanable funds market. If you have any questions, write them down in your notes, and we could talk about them on Monday. And this is the last major graph that you have to learn for Unit 4. Thanks.